Welcome back, everyone, to the Noob Selling Options channel. It is absolutely fantastic to have you hanging out with us for another explainer. Now, if you're serious about optimizing your trades, and if you get some real value out of these breakdowns, do me a massive favor. Hit that like button and make sure you're subscribed so you never miss an update. Today, we've got an incredibly exciting one lined up for you. We are going to deconstruct a really powerful portfolio maneuver. It's a specific trade pivot that actively slashes your downside risk while literally multiplying your premium generation at the same time. Really, it's a total masterclass in capital efficiency, and we're going to break the whole thing down step by step using the latest market data. So here's our quick roadmap for today. First, we'll cover the massive DXYZ net asset value update. Second, we'll explain the exact trade pivot. Third, we're going to dive into the mathematical advantage. And finally, we'll wrap up with capital efficiency and your main takeaways. All right, let's dive right into Section 1, the massive DXYZ net asset value update. Because, every great options trade really needs a solid fundamental floor. The absolute magic number we need to burn into our brains today is 24.56. Recently, Destiny Tech 100 dropped a major prospectus supplement, and this was tied directly to their massive $1 billion at-the-market or ATM share offering program. Well, in those exact regulatory filings, they officially updated their internal valuation metrics, and they pegged the brand new, official net asset value at exactly $24.56 per share. Now, you might be wondering, why does this actually matter? Well, that move to $24.56 represents a roughly 23% bump in their net asset value. It brings their total portfolio value all the way up to around $742.5 million. And there are really two main levers driving that massive jump. First up, we've got the ATM issuance premium advantage. See, because DXYZ has been issuing new shares at a premium to market buyers through this continuous program, it basically acts as an immediate wealth transfer. Sure, it dilutes the public buyers, but it actively pushes the per-share NAV upward for the fund itself. And second, we have the private asset revaluations. They've seen some major internal secondary markups for their top holdings. We're talking about their massive Anthropic exposure, which sits at over 18% of the entire fund, and SpaceX at nearly 10%. These have naturally pulled those underlying asset values way up. So with the stock hanging around that $28.97 mark, this updated NAV completely changes the math on the premium. We aren't looking at that massive 45% plus gap based on the old winter data anymore. The fund's premium to NAV has compressed significantly, shrinking down to roughly 18%. Right now, the market is kind of still digesting that massive share dilution overhang from the shelf offering, but the core fundamental NAV, it's vastly improved. And that compression right there creates a prime fundamental catalyst for us to sell into. Okay, so how do we actually trade this? Let's get into Section 2, the trade pivot explained. This is where the rubber literally meets the road. We decided to take action and close out a single CRCL put, and we did that for a solid $162.69 net profit. CRCL was showing some really high intraday volatility, so just going ahead and locking in that green was, a highly disciplined move. But then, we immediately pivoted that exact capital into opening 3 DYZX July 17, 2026 $25 puts, and we collected $2.43 per share in premium for doing it. And honestly, the strategic brilliance of this pivot boils down to one core idea. By executing this move, we effectively swapped a single high-premium long position that was facing impending theta decay into a multi-contract short premium play where time decay is completely working in your favor. We took a volatile situation where the clock was literally ticking against us, locked in our profit, and totally flipped the script. Now, the clock is our best friend. It's paying us every single day as those 3 contracts sit comfortably above that rock-solid NAV floor. Let's move right into Section 3 and look at the mathematical advantage, because the numbers here are just fantastic. The capital requirements on this pivot, they are literally night and day. With that single CRCL $83 put, the underlying was sitting around $86.69, and our max capital risk, meaning the cash secured to hold that one single position, was a pretty hefty $8,300. But by pivoting over to the 3 DXYZ $25 puts, the underlying is so much cheaper at $28.27. So, even though we scaled up to 3 separate contracts, our absolute maximum capital risk actually dropped down to $7,500. And the absolute cherry on top here, instead of paying a premium up front, we generated a massive $729 in total net premium straight into our account. And guys, this is the true impact on your buying power. When you actually factor in that massive $729 net premium we just collected from DXYZ, The actual effective net capital locked up drops all the way down to $6,771. Think about that. You managed to scale up your contract sizing to 3 positions while simultaneously slashing your total capital exposure by over $1,500 compared to that CRCL position. That right there is how you aggressively manage your portfolio velocity. All right, let's wrap this all together in Section 4, Capital Efficiency and Takeaways. $22.57. That is our magic number. By selling the $25 strike and collecting that really rich $2.43 premium, we've basically engineered an effective break-even entry price of exactly $22.57. Now think about what that actually means. Our options break-even of $22.57 is positioned super comfortably below the true asset floor of the fund's $24.56 NAV, meaning if we actually end up getting assigned, we are effectively forced to buy DXYZ shares at an 8% discount beneath its true venture-backed asset floor. I mean, using option premium to engineer an entry price below private market book value is just textbook wheel strategy efficiency. If the tech premium holds steady or bounces, you just pocket that full credit. And if it falls, well, you've anchored an accumulation point below the actual NAV. Plus, and this is absolutely crucial, you are not just waiting around at the edge of a cliff here. With the underlying stock currently trading around $28.27, you've got an immediate 11.5% drop buffer before the stock even touches your strike price. You've lowered your absolute dollar risk, you've set a rock-bottom entry point, and you've built a structurally beautiful margin of safety. So, what does this all mean for you? I want to leave you with this question to really chew on. How are you leveraging fundamental asset floors to optimize your own portfolio velocity and slash your capital risk? Seriously, take a look at your own trades this week. Are you locking up way too much capital on volatile single contracts when you could be pivoting into heavily buffered multi-contract setups that literally pay you to wait? I highly encourage you to dig into your own portfolio and find these kinds of inefficiencies. Thank you so much for joining me on the Noob Selling Options channel today. Remember, please hit that like button, subscribe, and ring the bell so you're first in line for our next explainer. Keep optimizing those trades, and I'll see you next time.